Alright, a series that I've been known to do on this channel is the subscriber portfolio reviews. It's essentially when I go over portfolios of subscribers, people I know in the finance community, other creators, and more. The goal and objective of this series is to really open our eyes to different investing styles, other stocks that people are buying, so we can further research and get more exposure. So today, I had the pleasure of going over GenExDividendInvestors' $1.2 million portfolio. Thank you, of course, to GenEx for transparently showing his portfolio when a lot of big YouTubers like Jeremy won't do it. So today I'll be going over all of his holdings, share any input, what I'd like to see more of, and what I'd like to see less of in the portfolio. With all that out of the way, if you haven't already, make sure to subscribe, and if you want to go the extra mile, help support the channel, get access to exclusive episodes, a stock market competition, and so many more perks, make sure to check out Become a Channel Member today. And with all that out of the way, roll the intro.
Hello, I like money.
Alright, before I go over the portfolio, I really like to know investors' objectives, their age, their goals of the portfolio, and overall, just to kind of get a better insight on some of the holdings. Some holdings that might be good for you may not be good for me simply because of my age and your age. So GenEx is in his 40s. He's currently living off of the dividends in retirement, which is awesome to see. So obviously right now he's more of a place where he's looking for that dividend yield. And to get that dividend income up, he's not particularly looking for those low yield, high growth opportunities. But in the portfolio, we will see some of that. And the homework that I've done, he started this channel essentially to get free education because he was concerned of some health issues that he had, which big props to him for, being open about that. A lot of people won't, and it's just awesome to see that he's sharing his experiences with that, and he's really caring out for his family. Right now, he's making these videos, and he's living off the dividends he's supplying for his family, which is just awesome to see with the dividends, and he's educating his children about it too, which is just great to see. Alright, currently his portfolios make up $2.8 million. Currently his total dividend yield on the entire portfolios is 3.58%, and that's yielding just over $100,000 in dividends every year. Alright, let's move on to the holdings, and to start off, making up 11.71% of the portfolio, we have one of the highest quality companies in the world, which is Apple. I think it's crazy that it makes up over 10% of his portfolio, especially considering that Apple's dividend is really nothing to write home about at the moment. But nonetheless, Apple is an amazing quality company. Currently has $329,000 in Apple at the moment. The reason that I said it's crazy is mainly because of Apple's low dividend yield and lower dividend growth compared to a lot of other companies that he could be in. So props to him for obviously choosing quality over that yield. You guys already know my thoughts on Apple. I think it's such an amazing quality company. They have a moat over the smartphone market, and I think there's so much more room to grow internationally with that. I feel there's also a lot more room for growth in other markets that they're entering right now, like fintech, healthcare with their Apple Watch and the glucose monitoring, and eventually cars maybe. So I feel like Apple has so much potential in so many different markets that they haven't even tapped into yet. It's truly one of those businesses that I feel will continue growing for a long time, even though when people say they cannot continue to grow. That's what people were saying when they hit $500 billion in market cap. That's what people are saying at $1 trillion in market cap, and I feel that's what people are going to continue on saying. If Apple continues to go on a bit of a dip, I'm going to definitely continue to look to add. If I can get it in that 170, 160 range, I'd be very happy. It's crazy to think that Apple's dividend is really not that good right now. I feel that once they're done with their, massive capex that they're doing, their share buybacks, research and development, etc., and they kind of mature as a business a little bit, I feel they could have some crazy dividend growth in store, and your yield on cost could be insane with that if you own Apple right now or in the past. Alright, next is the second largest position in his portfolios. We have the best company in the world in my opinion, which is of course Microsoft, stock ticker MSFD, and Microsoft makes up 9.31% of the portfolio, which is an amazing allocation to have in these two giant companies. Having Apple and Microsoft make up nearly 20% of the portfolio, I think it's great exposure to not only tech, but I think long-term dividend growth as well. Not to mention they're also amazing businesses fundamentally. Now obviously Microsoft is a giant of a company, and millions of people use a Microsoft product every day, and the world runs on Windows. Microsoft has reoccurring revenue streams month after month. They have a subscription-based business, which I love. They have a toll booth business model, which I love. It's basically a company that just sits back, collects fees month after month, and really doesn't have to put in any extra work or any crazy capital expenditures to get that revenue. Not to mention, Microsoft also showed amazing pricing power during 2022, as I mentioned, with price increases, and have all the qualities an amazing quality company that you want to see. Not to mention, Microsoft's free cash flow growth is impeccable, and their financials all check out. Microsoft's dividend pretty much grows in line with the free cash flow growth year over year, which is roughly 10%. Microsoft is set to increase their dividend this coming month, and I would expect it to be in that 10% range as well. Microsoft also performs share buybacks as well. Right now, Microsoft may not be at the best price if you already own, but I think it's a fair price if you're looking for a solid entry point with an amazing quality company like Microsoft. Another thing with Microsoft that I haven't mentioned yet is the potential with their gaming business. With Xbox and Xbox Game Pass and the Activision Blizzard deal that looks like it's going to be going through, I believe Microsoft is poised to be one of the largest gaming companies in the world and one of the best gaming companies in the world if you were to buy Xbox alone as a company. I think Microsoft has so much potential with this as well, which is another reason I'm very bullish. I'm a huge Microsoft bull and I definitely approve this position. Next we have the cigarette giant Altria, stock ticker MO. Speaking of giant, they currently have a dividend yield near 9% and actually just hiked that dividend 4%. Altria is his third largest holding, which I don't know if I love as a core holding with the risks that are involved with it, but clearly he's looking for that dividend yield that Altria definitely offers, and looking at current financials and how their business is performed, I would consider Altria's dividend to be sustainable for now. Altria is a strong company that produces real free cash flow quarter after quarter and pretty much rewards it all in the form of dividends to shareholders. They also perform share buybacks as well. Altria is weird because it has declining smoking rates and nobody wants part of this company. With that said though, they've utilized pricing power to beat out inflation and have grown their earnings over the last few years. I'd like to see more consistency from Altria when it comes to their free cash flow department though, and I think that's one of the reasons they're trading down right now, along with all the risks that they have. Altria just always seems to be trading at a discount. Right now, Altria's stock performance itself has not been the greatest over the last 10-15 years. With that said though, Altria is definitely trading at a discount at the moment. I believe Altria is a solid position as any dividend investor, but it has to be a small to medium sized position. Obviously, he's living off that dividend yield and dividend income, and typically when you have companies that are over a 6 or 7% yield, I do get a little concerned. But with Altria, I talked about it in my most recent video, I believe that dividend yield is adjusted for all the risks and the discount that it's trading at. Alright, next we have the famous REIT, Realty Not Reality Income, which makes up 5.58% of his portfolio. Realty income is another weird one because of the slower growth rates compared to the S&P 500, but there's no doubt as a business itself, it's a very strong REIT compared to others. Realty income is also copycatting Vici a little bit and expanding into Vegas, which I think is a good move for the company overall. Realty income has a lot of properties that are set up to do well during a recession or tough economic time. Overall, I would definitely consider Realty Income's dividend to be sustainable. The dividend growth rates will obviously be a little lower though. Currently, Realty Income is trading at a really attractive price, sub $55. The thing with Realty Income though, as I mentioned, long term it has kind of underperformed the S&P 500 and the market overall. So I don't know right now if it's particularly screaming to be a buy for me, but at these prices I think I could get a solid return over the long term. But I would say for GenEx, obviously he's older. I don't think stock performance is exactly what he's looking for at this point. He's looking for that dividend income. I would definitely say Realty Income is a solid holding to have. Alright, next we got the healthcare giant Johnson & Johnson, stock ticker J&J, and I know Pierre from PK Investing is jumping up and down in his chair right now. J&J makes up 5.52% of his portfolio. J&J has been kind of weird with their stock price performance recently, and it's been trading a little flat over the last few years. With that said, though, J&J makes up 5.52% of his portfolio and currently has a dividend yield of 2.96%. J&J's also had some solid dividend growth ranging from the 4 to 7% range over the last few years, but you're going to not see anything crazy. J&J is definitely a solid company regardless, but the growth rates won't be anything crazy for sure. But it's a solid holding for him and the situation that he's in, which is something that we need to keep in mind here, because my situation is different than his. Alright, next we got the oil giant ExxonMobil, which makes up 4.86% of his portfolio. ExxonMobil, I do believe, is a pretty strong company, and these oil companies are hard to compete with. Although for my time frame, I do believe believe there is a bit of a risk with the rising electric rates, but everybody knows that oil still is prevalent today in America and across the world. Oil is used for so many different reasons every day across the world by billions of people. The reason personally that I'm not invested in any energy or oil stocks at the moment is the cyclicality of them. A lot of these energy companies manage their financials so during the bad times they have enough cash to keep paying that dividend. Alright, moving on, we have AbbVie coming in at 4.84% of the portfolio. AbbVie's a very strong pharma company, and it's been selling off a tiny bit recently due to the fears over the Humira loss that they could potentially have. AbbVie's financials may be impacted, and that may lead to slower dividend growth to what they had in the past. With that said, though, pharma's a giant business, and it's no doubt that it's going to be needed for a long time. I do really like AbbVie as a position, but I do have some questions over the long term and the sustainability of that crazy growth they had. With that said, I think they can maintain a solid growth rate in the future. I like AbbVie for sure. Alright, moving on, we have Pepsi, which makes up 4.75% of the portfolio. Pepsi's weird because it's really overpriced when you look at it, its valuation metrics, and it doesn't seem that it can offer a whole ton of growth in the future. With that said, though, they're an absolute staple of a company. They own so many iconic brands, and they're not going anywhere for the future. Long term, as a younger investor like myself, Pepsi's not the most glaring opportunity at the current valuations. Also, their payout ratio is creeping up a little bit as well, which is a bit of a concern for me, as I'm really investing for dividend growth and total return over the long term. Overall, though, I think Pepsi's a really good company at the right valuation. Alright, next we have Enterprise Products Partners, which makes up 4.54% of the portfolio under their oil giant. I'm personally not much of an expert on EPD all that much, but they do have a really high dividend yield and low dividend growth rate, and I'm not a huge fan of that. Also, they are taxed differently from regular stocks from the research that I have done. Me personally, I'm not touching EPD, and I'm not too big of a fan on the position. With that said, though, the dividend yield will definitely be driving in some income for them. Alright, next we have Procter & Gamble, stock ticker PG. PG makes up 4.17% of his portfolio, and Procter & Gamble is kind of like Pepsi. It's an amazing company, but it needs to be at the right valuation. I don't own any right now simply because it doesn't have any crazy growth rates. It's not really outperforming the market, so I'm not willing to pay that crazy premium that it's trading at. With that said, though, it is a staple of a company and it's not going anywhere, and I think for him it's a solid holding. Speaking of companies trading at crazy valuations, next we have McDonald's, stock ticker MCD. McDonald's is another company that I personally own, and I'm up a bit on it right now, but it's another one of those companies that it's not going to have crazy growth in the future. And while yes, it has outperformed the market, it's trading at a crazy premium right now. And right now with McDonald's, I'm not particularly looking to add. If we were to get to the 250s or 240s, I would definitely look to add for sure. McDonald's is a very strong company, though nonetheless, they produce real good free cash flow growth. Also, they have a very strong growing dividend, with their last hike being 10% and an upcoming hike coming soon. McDonald's, I think, is also going to benefit a lot with automation and robotics in the future, as they're a huge restaurant and they've already been toying with it a lot. I really like McDonald's as a long-term stock, but again, at the right price. But I do definitely approve of the McDonald's position, and I like it where it's at in the portfolio. Alright, next we have, of course, the beverage giant Coca-Cola, stock ticker KO, which makes up 3.48% of the portfolio. Now, Coca-Cola is another one of those stocks. It's a really amazing business, but only at the right price. Its growth has been really nothing to write home about. Their average dividend growth is really nothing great as well, pretty much being in line with inflation. And I just do have concerns with that payout ratio creeping a little high, how they're going to be able to sustain that growth in the future, or the dividend growth that I'd ideally want to see. Coke is a very strong company. It's not going anywhere at the end of the day, but future growth does have me a little concerned, as I'm investing for a very long time. But for GenEx, I think it's a solid holding for sure. It's definitely not going anywhere. If we're going into a recession, a very tough economic time, Coca-Cola is very unlikely to cut their dividend. While their payout ratio is creeping a little high right now, I do believe it is a very strong company, but it has to be at the right price. For me, it's not really near the right price right now. So for Coke, I'm just holding on to what I have right now. Next, we have Duke Energy, the giant utility, coming in at 3.32% of the portfolio. I like Duke a lot. I think it's a strong utility play. Utilities are kind of a sector that I'm still personally doing a lot more research on. NextEra Energy is another one of those companies that I'm definitely looking to add to. At this point, utilities are basically legal monopolies, so I definitely do like utilities, and I think it's a strong strong sector to really have in his portfolio, especially considering that he's living off of it. Utilities are going to be needed through the good economic times and bad. Alright, coming in at 3.26% of his portfolio, we have BTI, the British tobacco giant. One thing I noticed is that that's a lot of tobacco exposure, especially with Ultra in your portfolio already, but obviously he's willing to take on that bit of risk as he is living off those dividends, and they offer really high dividend yield, both of them trading near 9% right now. BTI is also a little weird as they do have inconsistent dividend payments when it comes to like the currency. Right now though, I don't own any BTI and I don't plan on adding. I already get enough tobacco exposure with Altria. Moving on, making up 3.12% of his portfolio, and the only ETF in here, it's of course the dividend ETF beloved by everybody, SCHD. Now, the thing with SCHD, me personally, if I'm looking for ETF exposure, I would potentially go 10 and 10, making up 20% of your portfolio with SCHD and VU, and that's eventually the plan for my portfolio. I just haven't gotten around to buying the VU part. With that said, though, SCHD has had some very solid total returns over the last 10 years, but there are some questions of how sustainable their dividend growth will be, along with how sustainable their total returns will be over the long term. As they've only been around since around 2013, there are a lot of question marks around SCHD right now. With that said, though, it's going to be very interesting at the end of the year to see their annual total payout, and they do pay this September, which I'll be keeping a close eye to see how much they pay me. SCHD pays him $3,000 every year, and that's definitely solid income if he's looking for that passive income through dividends. SCHD also is made up by a lot of the companies in his portfolio too, so it's a good thing that he's getting a lot of exposure through SCHD. I do like SCHD, but I would consider adding VU or Broad Market Index Fund. Alright, next we have Chevron making up 2.97% of the portfolio. Chevron is with Exxon. They're an oil giant. I already kind of talked about the oil stocks. It's very hard to compete with. They basically manage their cash, so during the bad times they can continue paying, and during it doesn't really matter when it comes to the cyclicality of oil's price of how their dividend is paid. Chevron's a giant though. I actually used to own Chevron, but again, if I were to ever buy back into these oil giants, it would have to be at a really cyclically low time like 2020. Speaking of another company that I used to own and sold out of, we have Southern Company, stock ticker SO, which makes up 2.63% of his portfolio. Another utility giant here. It's pretty interesting to see what they're doing with nuclear energy at the moment. I sold out of my Southern at around $73 a share when utilities were trading a little higher, and I put the money into a better opportunity in my opinion. With that said though, I do like Southern as a company. I like the utilities all overall, but I'd like to buy in at a cyclically low time when they're trading lower. Alright, get your diapers and Kleenex ready because we got Kimberly-Clark making up 2.52% of the portfolio. Kimberly-Clark has been trading pretty much flat, which is kind of funny because I bought into the stock in 2021 at pretty much the same price that it's at right now. So not great capital appreciation returns on that side, and that was one of the big reasons that I sold out. Kimberly-Clark is very reliant on the price of pulp and paper. I don't think Kimberly-Clark's going anywhere. I think they're going to continue to pay that dividend, but me personally, I'm not investing because of the slower growth rates and the lack of total return compared to the market. Alright, another tobacco company. We got Philip Morris, which takes up 2.23% of the portfolio. So he has pretty much a 10 to 11% allocation range right now in tobacco, which is a bit of a risk. I think long term, I would like to see him potentially sell out of that, but of course he is living off those dividends or the high yields that they offer. Me personally, I wouldn't love going that big into tobacco overall. I think a small to medium sized position in it, that 1 to 6 or 7% range, I think that's healthy for it. But me personally, I would not sleep great at night with that much allocation into tobacco. I'm sure he has his own investment thesis though on them, but me personally, I'm not buying it. Next, we got the industrial giant Caterpillar, stock ticker CAT, and this stock has been on a tear recently. It seems like you can never get it at a good price. They also have very strong dividend growth as well. Caterpillar makes up 2.07% of his portfolio. I love Caterpillar a lot. I'd love to see him add to this position at a good price. Caterpillar is a very strong business, and I think it will continue rewarding shareholders for that great dividend growth and overall total returns over the long term. I'd love to add to Caterpillar at the right price, of course. Alright, next he has Goldman Sachs, which makes up 2.04% of the portfolio. I like Goldman Sachs overall. I think they're a pretty strong company, and they offer him a pretty high dividend yield with some solid dividend growth as well, with a 3-year dividend CAGR sitting near 26%. I definitely like that position a lot. Next, we have Toronto Dominion, aka TD, the Canadian bank, which makes up 1.75% of his portfolio. Canadian banks are companies that I'm kind of researching right now as well, as I've heard that they have very monopolistic features. And there's basically a big 6 or 7 Canadian banks. That's something that I'm still researching right now, but from what I see, I do like this position. It also offers some solid dividend growth and solid dividend yield, so I approve a TD. Alright, get your pearly whites ready because we got Colgate, stock ticker CL, coming in at 1.72% of the portfolio. Colgate's kind of like Kimberly-Clark. The price really hasn't moved in the 2 or 3 years that I've been away from this stock. They have solid dividend yield, not great dividend growth. Me personally, I'm not touching Colgate. I just don't see anything appealing about it at the current valuations. Next, we have Home Depot making up 1.16% of his portfolio. This is a smaller position. I like Home Depot a lot. They're a duopoly basically with Lowe's. Thing with Home Depot though is that they're very reliant on real estate, the real estate market, the housing market, what people are buying to upgrade their houses with, and this is ideally a company that you want to buy during the lower times, and it's a company that I'm going to be looking to buy when it's a cyclically low time. If they have very strong dividend growth though nonetheless, with a 3-year dividend growth rate of 16.38%, and it offers some solid dividend yield at 2.55%. I like Home Depot, but I'd have to get it during a low time. Alright, I'm fired up on this next one, which is of course Starbucks, stock ticker SBUX, coming at 1.07% of the portfolio. If he's looking to add to Starbucks, I think right now it's one of those times buying a great business at a fair price. I think they're trading near that fair price range right now. It's a smaller holding in his portfolio, obviously, but I do love Starbucks so much as a company. Whether it be the rewards app and how they're basically they're getting interest-free loans through the customers. If you couldn't tell, I really like Starbucks, and I've actually made a lot of videos talking about why I love it so much. Starbucks is just such a strong business. I feel it's a global brand, although there is a lot of risk with China and how that performs. As I mentioned last quarter, they produced the largest amount of free cash flow they have in a while, and in turn they're set to hike their dividend this month. I don't know personally what it will be, but I can't predict it. Last time it was around 8 to 9%. I'd expect it to be a little in that range as well. I do love Starbucks though long term as a company. I'd love to buy some at these prices if they can go a little lower into low 90s, 80s. Next he has the Travelers companies, which makes up 0.88% of his portfolio. This is actually just a company they talked about in my Dow Jones ranking video. I've never really heard of this, but they're an insurance companies. They sell insurance to people, which is obviously a business that's always going to be needed, and they have really solid financials and free cash flow. It's a company that I may be looking at, but I do like the position overall. And lastly, he has Pfizer, which makes up 0.63% of the portfolio, and me personally, I'm not a huge Pfizer guy. It's always one of those stocks that I feel is going to be trading at kind of a discount. I mean, I don't love Pfizer. It's one of those pharma companies. Obviously, I mentioned pharma is kind of a dirty business. It's in a really small position, so I mean, he could potentially settle out again and add to one of those core holdings. I don't love it though overall. Alright, those are all the holdings, so here are my overall thoughts on the portfolio. To start off, I think it's really important to just note that his investing style and goals are much different from mine. He's obviously living off of these dividends, where for me, I'm planning to live off of them, but I'm not exactly investing for the yield and that dividend income like he is at this point. With that said, there are a lot of companies that I can both agree are really solid companies, but a lot of them are really overpriced, more mature companies, and just don't have the growth that I'm particularly looking for in my situation. Nonetheless, they're very strong companies, and overall, I'd give his portfolio a 7.5, 8 out of 10. For his situation, it's a really solid portfolio. I do like that he has Microsoft and Apple as 2 core holdings. I think that kind of adds some balance when it comes to the growth part of the portfolio. Again, huge thank you to GenEx for sharing his portfolio. Not a lot of people will show their portfolio in the first place, so big props to him. Go check out his channel if you haven't already. That's all for this one. If you want to have more conversations with other dividend investors and me all day long, join the Discord link in the description. Thank you. Of course, smash the like button if you haven't already. Subscribe. Become a member if you want to go the extra mile. Get exclusive episodes, stock market competition, all other great perks. Thank you. And of course, do dividend stocks, not drugs. Have a good one.